You've been granted ISO incentive stock options. Congratulations! But should you exercise them? There are very important factors that you should include in your decision that we're going to cover in this video. So keep watching. Hi, I'm Julie Merrill. I'm a CPA. If you're new to my channel, thanks for watching. I help professionals and business owners grow their wealth and save taxes along the way. In this video, we're talking about ISO stock options, the tax impact, and factors that you should know about that could sway your decision on whether you should exercise them or not. Now, before we move into the tax impact of your decision, there are 3 questions that I want to ask you before we even get into the numbers. The first one is, do you believe in the company? Because the upside is big. That's why we want to buy the stock options, right? And have the stock in the company. But the downside is that the company goes away and now your stock is worthless. That's the risk. So do you believe in the company? That's question number 1. Question number 2 is, do you plan to stay at the company long enough for the stock options to vest? Typically, you don't get just a chunk of stock options, if you will, and that not have a vesting schedule. Many times there's like a cliff, so maybe you have to work for 12 months for any of them to vest, or maybe there's a 4-year vesting where you have to stay at the company for 4 years. Do you plan to stay there long enough for your stock options to vest? Because even if you exercise them and purchase them, they're not yours until they vest. So what is your plan to stay at the company? And the third question is, do you have the cash? There's a price to those stock options to exercise. Do you have the cash right now in your account to actually exercise those stock options? Those are 3 things that if you answer yes to, you want to continue watching the video because we're going to dive into the taxes. But if you answered no to any of those questions, you might just want to pause and stop and see if actually exercising your stock options is a right move for you today. All right, let's dive into the taxes. So one of the big benefits of ISO stock options versus NSO, what is the difference right here? One is qualified and one's non-qualified. The tax treatment of non-qualified stock options is very different than the tax treatment of qualified, which is what we call ISO incentive-based stock options. With NSOs, you're taxed when you exercise on the difference between the fair market value and what you paid, so your unrealized gain. On ISO stock options, there's no income tax and no payroll tax on the actual exercise. But there is a hidden, sneaky, evil tax called alternative minimum tax, and we're going to get into that in a second. Key things to know when you're looking at exercise. What is your exercise price? You're going to have a price per share where that grant was granted to you for stock options and what you pay. That doesn't change. And then you have this kind of moving value, which is the fair market value of the stock, and the difference between what you pay, your exercise price, and that fair market value is going to drive your tax impact, your alternative minimum tax for ISO stock options. In a new, like a startup company, many times we do valuations on the company, and it's only done really, not even once a year, it's usually done when you raise more money. So you'll do a valuation, you'll say, okay, the stock is worth 10 cents a share, $1 a share, $5 a share, whatever that is. And then that price stays with the company price until another valuation is done. If you have a public company, that changes all the time. So your fair market value is going to depend on whether you are in a startup or a public company, and then whether that price moves more often than like just every time you do a new round of funding. So that's going to really factor into the fair market value price of the stock. Your exercise price is not going to change. If it was granted to you and your exercise price is $1, it's going to be $1 whether you exercise it today or in a year. One of the things, though, you need to calculate, and this is a great time to have an expert tax preparer or tax advisor in, I would say your Rolodex, but that's like so old school, that just aged me, in your back pocket, in your iPhone, is to understand what that means. So a couple things. It's going to drive alternative minimum tax. It's your unrealized gain. So if you've got 1,000 shares and you have $5 exercise price, you're going to pay $5,000 to exercise. But if that is valued in the market at 11, so now you have a $6,000 unrealized gain. That is now going to be a factor into your alternative minimum tax. So that's how it kind of works on your tax return. So you're not going to have income tax. You're not going to see it on your W-2. You're not going to have payroll taxes. For non-qualified, you will. but not for ISOs. You're only going to see it when you file your tax return. And so being proactive and having those discussions with your tax preparer is so important. Now, there's another thing to consider if you're early exercising. Sometimes, and many times, companies will let you exercise your options before they vest. There is a form called 83B, and again, it's super time sensitive. You have to file it within 30 days, and it locks in that unrealized gain between the day of your exercise, so the difference between your grant price and the fair market value price. It's something you want to talk to your tax preparer about. If you have an HR person, they might give it to you, but they're not going to say whether you should file or not because of liability reasons. It's definitely time to get a call or a consult in with a tax advisor. So once you understand the AMT, the alternative minimum tax effect, then you might decide, when am I going to do it? Am I going to do it today? Do I have the cash? Should I exercise it today? If your company is public and you can sell it at any time, what we recommend doing is, if you're going to exercise, do it in the early part of the tax year. So January, February, March, so that you have time to see what the market's doing or the price is doing for the next 9 months to decide if you're going to sell or hold. The AMT only comes into place if you exercise the stock options and not sell it by the end of the year. If you sell it within the same tax year, there is no alternative minimum tax because you're just taxed on the gain. So there's no unrealized gain. You have a realized gain because now you have a sales price. You've sold the stock. If you're going to exercise, consider doing it as a timing-wise consideration, doing it early in the tax year so you have time to consult with your tax person. You have time to look at the fluctuation in the price. You have time to decide whether you're going to sell in that tax year, because sometimes paying short-term capital gains is more beneficial than waiting until next tax year, having an AMT tax today and then having a capital gain next year. You might still be paying more. So that leads into my kind of next tip is, and I've mentioned it already in this video, is having a tax advisor that knows stock options in your back pocket. So having these calculations as part of your decision making, being proactive about it, truly understanding what is going to be the tax impact when you make that decision to exercise, and whether you also thinking ahead on always keeping the end in mind, when can you sell it? If it's a private company, you're not going to be able to sell it until there's some type of liquidity event. If it's a public company, you have a little more control. Once you exercise it and it's vested, it's yours, so you can sell it, but should you? So again, bringing a tax expert into this conversation is so critical. I cannot tell you how painful it is to have a conversation with a client when I'm brought in tax filing time, right? The next tax year, so we can't change anything. We can't do anything. It's already done. It either was exercised and not sold, or exercised and sold, and explain to them why they have a 5-6 figure tax bill. It is, it's so painful. It's painful for me to tell it. It's not even coming out of my pocketbook. So don't make that mistake. Understand the tax implications before you exercise, before you sell. Have the end in mind so you know when you're planning to sell, and get a advisor in your phone, in your email, that you can consult with so you understand the impacts of your decisions. Now, if you'd like more information on this topic, I have a couple blogs I've written on it. I'll put the links below in the description. I also have a link if you're interested in booking a call with me or my team to discuss your stock options and the tax impact. If you already have a tax advisor, that's fantastic. Reach out to them. And if they don't understand stock options, find somebody who does. Even if it's another colleague who's been through it, someone who's had a tax bill, talk to someone who can really explain and show you what your tax impact is so that that can be part of your decision. If you like this video and would like to see other videos like it with helpful tips, please ring the bell and follow my channel. I'm Julie Merrill, and I'll see you next time.